Welcome to Pandemics, Elections, and Retirement, Charting Your Financial Course. I'm Ed Leedom, financial consultant with withWebb Financial Group. withWebb Financial Group and Hopewell Federal Credit Union have had a relationship going back 15 years, and over that time period, we've helped literally hundreds of Hopewell Federal Credit Union members to chart their course to financial success. 2020 has certainly offered a lot of opportunities to take stock of your financial situation. The key with any of these types of things is to keep a long-term perspective. Issues that are a big issue today likely won't be in 10 or 20 years, but you can be prepared for it. And so let's take a look at how you can begin to prepare. Getting your first job. That is a big step for everyone. And as you do that, there are certain things that you might want to consider. Number one being establishing a budget. Before you go out and buy a car or buy an entertainment system or anything of that nature, you've got to have a financial plan in place. Everyone is excited when they get that first job, but if you establish a budget in the beginning, a realistic budget, and you stick to it, over time, you'll eventually get to where you want to be. The key here is to realize that financial security takes time and may require trade-offs. If the question is furniture or a car, save up for one of those and only use credit for major purchases. Managing credit is one of the keys to long-term financial success for most of us. And lastly, remember that your available income each month is after tax and Social Security payments have been taken out, which means that you likely will have 25 to 35% less than your gross pay. Now, after you get that first job and you go look to settle down, chances are many people will get married. So congratulations, but what's next? Well, sharing your life with someone is definitely a big change. If you're getting married, that's a great time to take a look at your estate plan. Consult an attorney about a will, a living will, and healthcare powers. You might be buying a house, which, if you remember from our earlier slide, should be no more than 30% of your monthly income. But that includes your mortgage payment, whether it's conventional, FHA, or if you're looking at other down payment options. That's something that the folks at Hopewell Federal Credit Union can help you with. In addition to the mortgage, you've also got homeowners insurance and property taxes. All of those things go into that 30% of monthly income. Secondly is your life insurance. It's no longer all about us. It's about us and someone else who is sharing our life. In terms of life insurance, how much should you typically have? And the general rule is 5 to 7 times your annual income. Life insurance helps to create an instant estate, which can be used for expenses like mortgage or car payments, living expenses, or to fund an education for your children, or even for your spouse if something should happen to you. Two other very important areas to consider are managing credit and saving for retirement, which we will look at as we go throughout this presentation. Smartly managing revolving credit, in other words, credit cards, means not spending more than you can afford to pay off in a short period of time. It is not designed to be a long-term solution for major expenses. The time value of money works for you when you save and invest, just as it works against you if you have significant debt. You can work for your money, or you can have your money work for you. Now, after you've gotten that first job, you've gotten married, what happens next? Well, for many people, it's having children, which is another great life milestone to use to evaluate and reevaluate your life insurance needs. Is the amount of insurance that you have currently equal to your current financial need? If you got a $30,000 policy when you were in your 20s, and now all of a sudden you're married, you have children, it's a good time to check that coverage and make sure that you still have enough insurance, that the beneficiaries on the policy are up to date, and also to check to see if both spouses have coverage. Having children is not only an exciting time in a person's life, it's a great time to look at providing for your children and your spouse until your children can become financially independent. Reviewing policies, as I mentioned, for coverage amounts, beneficiaries, and current policy values is a great way to do an insurance checkup. Also, when you have children, your parents become grandparents, and life insurance can be a great way for them to leave an inheritance to their grandchildren, as can a 529 plan. Now, what is a 529 plan? Well, it's a college savings program sponsored by states, in our case, the state of Ohio. You can contribute up to $4,000 per year per individual that the account is designed to benefit. Deduct that from your state income tax. 529 plans, whether Ohio's or a different state, feature a wide range of investment options, professionally managed by leading investment managers, and subject to the oversight of the state government. And so that you can invest in those types of programs and be confident in the overall management of those types of programs. Now, another option for parents or grandparents, once your children have earned income, would be a Roth IRA. That can be used to pay for qualified education expenses, and it can also be potentially used for up to $10,000 as a down payment for first-time home buyers. In a Roth IRA as well, contributions and the returns on those contributions are exempt from taxes as long as you save that money up until retirement. Now, some things to consider during these life events. We talked about the importance of budgeting. We talked about insurance, but creating an emergency fund is also a critical piece to long-term financial wellness. A minimum of 3 to 6 months worth of expenses should be set aside for a job loss, car repairs, medical copays and deductibles, or even deductibles on your auto insurance. These investments are typically kept in stable, liquid, which means easily redeemed, investment products. The emergency fund is considered to be short-term savings and should be separate from your longer-term investment fund and from your retirement savings. The money should be accessible at any time with no penalties or fees assessed. That is why an interest-bearing savings or checking account or a money market fund with check writing privileges would be ideal. Now, saving versus investing. What is the difference? Savings is typically for a short-term time period, 1 month to 5 years, and it's for short-term goals where fluctuation in the value of investments is not desirable. You want to have access to your money, and you want to make sure that the amount of money you put in there is still available to you. And so therefore, you would keep that money, the short-term savings money, in very stable products like CDs, interest-bearing savings and checking accounts, or a high-quality short-term bond fund. However, investment accounts are different. They are designed for the longer term, typically 5 years or more. And they use investment vehicles that can fluctuate in value, such as stock funds, variable annuities, and managed portfolios. Now, we briefly mentioned life insurance before. Life insurance is used to create an estate, as I had mentioned. And using life events as an opportunity to have a professional review of your existing life insurance policies can reveal potential gaps in coverage. Life insurance can provide money to help take care of outstanding debts so that your family does not have their life disrupted. Having to move, sell their house, taking on loans for life expenses or for education, or selling valuables in order to pay bills. A person making $40,000 a year should have typically between $200,000 and $300,000 worth of life insurance. And what I often hear from clients is, well, I can't really afford to have that much life insurance. So let's discuss term life versus whole life insurance. Term life is just what it sounds like. It is only insurance for a period of time, a term, in other words. Typically, that term will be anywhere from 10 to 30 years. Whole life insurance combines the cost of your insurance with an investment account attached. And whole life insurance can cost from 5 to 15 times as much as term life insurance. Now, using that example of someone making $40,000 a year, let's look at that in more detail. A term policy, if you got a term policy for $200,000 to $300,000, depending upon your age, your health, and some of your lifestyle factors, that insurance might cost you $30 a month. If you're paying $30 a month for a term life policy, a whole life policy for the same amount could cost anywhere from $150 a month to $500 a month. So as you can see, term life insurance is a very affordable option if you need to have life insurance. Now, the next step, after you've gotten your first job, you've gotten married, you've got a house, you've got children, what happens between the time you have children and the time you actually start to retire? Well, that's when most people start to think about retirement and putting money aside. But I often get the question from clients that I meet with about the best time to start saving for retirement. And the answer is now, as soon as you possibly can. So once you start to do that, how much should you invest for retirement? And I can say that if you put between 10 and 20% of your income away over a 40-year working career, and you have a combination of stock, what are also called equity investments, and bond investments, known as fixed income investments, over that time period, let's say you invested $350 a month, taking this same person that makes $40,000 a year. If you earned an average annual rate of return of about 7%, which is what the stock market has averaged over the last 80 years or so, you would have almost $900,000 in 40 years. Now, that amount of money is enough to fund about 90% of your what's called pre-retirement income. And when you add Social Security on top of that, you could potentially be making more in retirement than you made when you were working. And that, in most people's opinion, is an ideal retirement. But one other thing on retirement savings. Check with your company to see if they've got a retirement plan or a 401k plan that offers a match. Because that match, if you contribute enough to get that full match, is like an instant return on your money. Now, planning for X. What do you do when the unexpected happens? Well, I think we can all agree that 2020 is a year that we'd all like to see come to an end. But when the unexpected things happen in your life, the key is not to panic. Just calmly and rationally take stock of your current situation, understand where your resources and assets may be, and how they've been affected by events. Now, we've discussed so far the importance of having a budget, creating an emergency fund to deal with unexpected expenses, having a will or trust to administer your estate, and reviewing the importance of saving, investment, and retirement accounts. If you've taken the steps that we discussed previously, the unexpected happening is much less worrisome, as you potentially would have the resources to handle unexpected events. Uncertainty can be scary, but it can also create opportunities if you're prepared. By taking steps now, such as reviewing your accounts, you do not have to do everything yourself. You can bring in investment experts, legal experts, tax experts, and all of us are available and willing to help you in order to optimize your financial situation. No one can anticipate everything that may happen, but you can be prepared to handle whatever life may have in store for you. If you have questions, since we're not doing a live broadcast today, please feel free to reach out to your local Hopewell branch, and we can either set up an appointment, or I can talk to you via phone or via email about any questions that you may have. Thank you very much for your time today, and I hope that you're all successfully charting your financial course.